Welcome back to Simply Money. Tonight, we're going to be doing something different. We're going to be doing a live question and answer. We're going to be dealing with some of the most often asked questions that I get, whether it be through email or from comments on other videos. And I have some that have been already sent in. I'll be starting with those. And as the video continues, as we continue through this live stream, feel free to throw in your comments or questions in the chat. I'll do my best to get to each of those as they pop up, and I appreciate you joining me tonight. So we're going to start out just with a few little fun facts as we wait for folks to jump on, as it's just going live now. But the first thing I wanted to share with you is, did you know that inflation has made the $100 bill in 1950 worth only $11 today? Think about that. In 1950, you could be holding a $100 bill, and the purchasing power that that would have. Today, it only buys you equivalent of $11. That's the power of inflation, and that's the cost of holding cash. Holding cash loses value over time. That's why investing builds wealth, and why it's so important that we not only save. I had someone comment the other day that if you learn to save, then you don't need a budget. And that's not necessarily true, because just because you're saving the money, you may be putting it in a high yield savings account or even just in a checking account, and it's not keeping up, outpacing inflation. And so you're not building wealth. Yes, you're doing great living below your means, and that's step one. But you have to continue to budget that money that you're saving and figure out, are you investing it in your emergency fund? Are you investing it in long-term growth? Are you investing it in a passive income stream, whether it be into real estate or dividends or some other form of asset building investment? So budgeting just means, let's just say I have $300 a month extra. You're saying, oh, I'm saving each month. That's great. You're doing a great job. I don't need a budget. Yes. What are you going to do with that $300? What allocations are you going to give to that $300? Is 100 of it going to go into a bucket for, an upcoming expense, maybe, something on your house, a car? Or is it going to be going toward investments long term that you won't need it for 5 or 10 or longer years? So that is very important to look at that, as well as budgeting, as well as saving. And so yes, you do want to save, and that's a big step, but you have to still budget. Another fun little fact: did you know that the average $1 bill lasts about 6.6 years before it needs to be replaced? The Federal Reserve, the Treasury, they take in old bills, they actually dispose of them, destroy them, and they replace them. That's not counting the money they add in, the extra printing they do. The printing money causes inflation. We can get into that on another video, but just replacing bills because they're being worn out. So the average bill lasts about 6.6 years. I wonder, how long's the average $1 bill last in your account? That'd be a good question to get us started. For a lot of us, I don't think it's 6.6 years. It may be much less than that. A couple more little fun facts. Warren Buffett made 99%. Listen to this carefully. 99% of his wealth after turning 50. That's the power of compound interest. Yes, he started early, he's lived a long life, but 99% of his wealth has been built after turning 50. So something to think about on the compound power. Let's see, another fun one here. About 40% of lottery winners go broke within 5 years. Why is that? Why is it people who come into exorbitant amounts of money, millions of dollars, go broke within 5 years? Why is it that so many professional athletes, look at the NFL, NBA, how many professional athletes make millions and millions of dollars, and so many of them end up flat broke after their career is over? Because it's not about how much money you make, it's about how much money you keep. And that's something that we look at on this channel a lot. Is a lot of people, I think, where's the statistic I had the other day? It's something like, oh, here it is, 25% of millionaires, actually it's a little bit more than 25% of millionaires, never made six figures in a single year. means you don't have to necessarily earn a big income to create wealth. It's about what you do with it. So 40% of lottery winners go broke, not because they have not enough money, it's they don't have a budget, they don't have discipline, they don't understand money. That's why we created this channel, is not just to learn how to build wealth and learn how to invest, but to understand, to build financial literacy. Those are some important things we need to understand as we begin building up uh, our wealth and our money knowledge. So building financial literacy is very important. So let's go to some of the questions we have. We'll get started with that. First question we had: what's the best way to start investing in the stock market? A lot of people may ask that. They'll be like, I don't even know how to get started. I don't know what to do to get started. And so the best thing to do, and it sounds simple, I'm not trying to, mock this question, but the best thing to do is to get started. We did a video just recently on, how to get started investing with as little as $1, because a lot of people think they need to wait till they have $1,000 or $10,000 in order to invest. I've heard people say, "Oh, I haven't started investing yet because I don't have enough money." You can invest with fractional shares, which is available on places like Robinhood, M1 Finance. You don't have to buy a complete share. You can buy fractions of shares, meaning you can start with even $10 a week. You put $10 into the account and you have it allocated. And how I would recommend, especially for beginners, is just to put it in an ETF like FXAIX. This is an S&P 500 index fund. It's extremely cheap, 0.01% expense ratio, which is basically nothing. It's averaged about a 10.5% percent return over its lifetime. So it's a great way to be diversified in the top 500 companies in the stock market and be able to do that in fractional purchases. You don't have to buy an entire share of FXAIX. It'll buy whatever $10 would buy. If you have $12, put $12 in. So you don't have to wait until you have a certain amount. In that compounding over time, even $10 a week over 5 years would grow to, if it averaged what it has, would grow to about $3,300. I know you're probably sitting there going, well, $3,300, that isn't a lot. No, it's not, and neither is $10 a week. But it's the point about getting started and beginning to accumulate and letting compound work for you. Because if you keep doing that, after 10 years, now you're looking at $9,000. And if you continue that after 20 years, you're around $33,000. So the point is to start. The question is, what's the best way to start investing with a little money? Is just open up an account. If you don't have a 401k at work, open up an IRA or a Roth IRA, which is even better. If you don't understand what those are, we have videos on the channel that explain the difference of Roth IRAs, traditional IRAs, SEPs, and then 401ks, and what those are and how the differences are. But you can just go to somewhere like M1 Finance or Robinhood and open up an account and then begin putting that small amount in and let it compound and let time work for you. So that's question number one. Question number two is now a good time to invest in the stock market? You'll hear this particularly when the stock market is very volatile, or if it's in a bull market, or I'm sorry, a bear market where it's beginning to fall and go down. People are like, oh, I don't want to buy. It looks like it's a bad time. Right now, there's a lot of turbulence in the stock market because there's a lot of news going on. There's a lot of uncertainty happening. We have currently, a lot of talks about tariffs. We have a lot of uncertainty. There's a lot of political chaos. There's world news happening. And those types of things drive the market up and down. So it's much more volatile than it normally would be in more steady times. There's times when the market's seeming like it's just going up, 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 up. And we have other times like 2022, it seemed like it kept going down. Just when it would make a little headway, it'd dip down again. You have big dips like COVID in 2020. In March, it just plummeted because there was fear. It was worldwide chaos and fears, economical uncertainty. And so one day it's down another day. And so people wonder, should I invest in the stock market? And my opinion is yes, the time in the market beats timing the market. Don't wait and think I'm just going to wait till it's a good time to invest. If you've paid off your debt, you're on a budget, you're living below your means, and you're allocating, a percentage of your income to go to long-term investing. You've set up an emergency fund. If you've taken care of these basic things, then yes, you should be investing. And the stock market's a great place for long-term growth. Over the history, the S&P 500, for example, VOO, or like I said earlier, FXAIX, have averaged 10% annually despite these downturns. We've had years where it's been down 20, 30, 40%. But on average, over 10, 20, 30 years, it's averaged 10% return. So you're not investing for short term. You're not investing for quick gains. You're investing for long term wealth growth. That's what we're in for. So, yes, I would absolutely recommend investing in the stock market, even in these volatile times, even if you're uncertain. And that's where being diversified in like FXAIX is a really good place to be. I have a lot of my portfolio in SCHD because not only is it diversified in about 105 companies, but it's diversified in various sectors as well. And that's what I like, but I'm at a different age. So again, you are going to have to decide on a lot of factors. How old are you? How much time do you have? What's your goal? Are you looking for income? Are you looking for long-term growth? So these are all factors you'd have to decide. But regardless of the factor, it's not where in the stock market should you invest. That's not the question. The question is, should you invest in the stock market? In my opinion, is absolutely yes. And that is what dollar cost averaging will do. And we may touch on that a little bit here. But dollar cost averaging means that you're putting a set amount. Let's just stick with the $10 a week. $10 a week, whether the market's up this week or down this week, you put $10, $10, and you're repeating that in up markets and down markets, and you're averaging out over time. And so when the market's down, you want to make sure you buy because you're getting those lower costs. You're buying more for your dollars. And then when the market's up, you're not getting as much, but it averages it out. And long term, you get that 10% growth. So it's a great way to ride out that volatility. So we're going to continue on here. Some other pre-submitted questions we have. What is the biggest mistake people make with their money? And this list could be so long. Um, you know, I think the biggest one, let me throw out just a couple others before I get to what I think is the biggest one. You have things like budgeting, not knowing where your money's going. That's a huge detriment to your ability to build wealth. Um, Keeping up with the Joneses mentality that, especially today and with social media, you see all these people, all the, vacations and cars and homes, and you think that's normal what people are doing, but you're not seeing their debt, you're not seeing their stress, you're not seeing all these other things. All these different things could be considered, the biggest things, but I think the biggest mistake people make is lifestyle creep or lifestyle inflation. And that's where every time you get a raise, you increase your lifestyle. If I get a pay raise, I get a nicer car. If I get a pay raise, I get a bigger house. And people do that on a regular basis. Every time they get a pay raise or change jobs and they get an increase in their income, they continue to increase their lifestyle. And that's the biggest mistake. I think if people would learn early on to, set that budget, doesn't mean, if I get a pay raise, doesn't mean I don't increase some things, but if I'm paying off debt, if I'm getting those things out of the way, once I have that freedom, and if I'm getting pay raises, let's just use some arbitrary numbers. Let's just say I get $1,000 a year pay raise. Instead of spending an extra $1,000 a year, maybe I spend an extra $100 a year. And I know, people are like $1,000 a year, that's nothing. But even if you did that every year for 20 years, in 20 years, you're making $20,000 a year more. But if you're keeping that lifestyle to pace, you're not gaining any ground. So instead of spending, all of it, maybe you give yourself a 10% of that raised, or 20%, depending where you're at, if you have your debt paid off, etc. And then you put the rest toward investing and growing your wealth. And that is, especially if you start that young, keeping that lifestyle in check and allowing that money to grow and build over time. So I think that's probably the biggest mistake I would say that people make, is allowing lifestyle inflation to erode their wealth building opportunities. And that goes back to the whole, the social media and TV, everything we see, like all the flash. And, one of my favorite quotes, and I tell a couple of my friends this all the time, is I would rather be rich than look rich. I don't care, you know, what I dress like. I don't care what my car looks like. I mean, I want a car that's, at this point in my life, I want a car that's reliable. I want a car that's safe, that has some comfort, but I don't need the fanciest, the newest, and the flashiest car. I don't care. I don't care if people look at me like, "Oh, that's what you drive. You drive a Honda?" Like, I don't care. I enjoy it. It gets great gas mileage. It's safe. It's going to last me a long time. I'd rather continue to put that money toward, building my wealth and my, legacy for my kids. That to me is more exciting. And a lot of people are just all about, the newest car and the flashiest stuff. And that's where that lifestyle creep just gets you. I apologize. I'm still getting over a cold, so I got a slight little cough here every once in a while. So I apologize for that. Let's see. Here's another question I had, and we've done a couple videos on this. Got really in depth. I do actually a series of, can I retire with $700,000 at 55? Can I retire at 60 with $600,000? But the question is, how can I retire early without needing millions of dollars? And, that's a lot of people will ask that, like, how much do I need to retire? Can I retire if I have $2 million? And other people are like, I'm never going to have $2 million. How can I retire early, let alone, retire on time? But I'd love to retire early if I could. And how can I do that without needing millions of dollars? Because you'll hear people say, oh, you need, $3 million in order to retire at 55. And that goes back to what we talk about all the time. It's very unique for you, for yourself, and where you live and your lifestyle you want to live. If you want to take private jets and, go on a trip around the world every, 2 or 3 months, then yeah, you're probably going to need millions and millions of dollars. But if you want to live a normal, average retirement where you have freedom, you have the ability to do things, the number one thing you need to do is reduce your cost, cut your expenses. That's why we talk all the time about reducing your debt, eliminating your debt, getting your debt paid off. Once you have that paid off, I tell people, they're like, well, I need $3 million, whatever. I tell people to kind of imagine what your life is right now, whatever your monthly expenses are, and then subtract your mortgage, subtract your cars, subtract your credit card, student loans, any payments that you have that are debt payments, subtract all of that. Then what is your monthly expense? And even if maybe you add in, $500 or $1,000 a month for travel, what is your monthly expense? And it's going to be severely less. It's going to be far less than what it would be with all of that debt. And then you can look and say, well, yeah, maybe I don't need, $1.5 million to retire because I don't have all this debt that I have to pay each month. My month to month bills are really insignificant in comparison to what it feels like right now. So help yourself by visualizing that. Make a vision board with the things you want to do when you retire, and make a column with all your expenses now, and make a column with all the expenses minus all your debts, and see the difference and see, this is my goal. This is my vision, to get out of this debt as quickly as possible. Just a super easy, and I'm not a 4% rule guy, If you watch some of my videos, I've shown how you can, find, other income streams, some dividend investing, whether you're into real estate, different things. Not to forget that you'll, eventually have Social Security. Perhaps you work in a job, you'll have a pension. Don't forget those income streams. But just for a simple, quick math example, if I have $500,000 and I use the 4% rule, it means I get $20,000 a year in perpetuity, that forever. For the most part, I'm not going to ever have to worry about that money running out. And that $20,000 would increase with inflation year after year. The 4% rule says you take your, amount, $500,000, you take 4% of that. That's $20,000. And then next year, that $20,000 is increased by whatever inflation was that year. So if it was 3%, you add 3% to the $20,000, and that's what you withdraw that year. And each year you increase your withdrawal by inflation. It's not 20,000 static for 30 years, because in 30 years, that $20,000 isn't going to have the same buying power. So the 4% rule allows you to give yourself a cost of living raise each and every year, and not, deteriorate your portfolio, your fund. And with that, you can also, you know there's a lot of debate on, some now say it's only 3.5%, but the uh, actually it's closer to 5% that the author of that says you can actually do now. He's done further research that 5% would actually be closer to what you could withdraw. And there's other factors to look at. How old are you? How long do you expect it to last? Maybe you take out 6% for a couple years, and then when Social Security kicks in, you drop it down to 5%. All sorts of ways to do that. There's guardrails. But the point is, you don't need millions of dollars to generate the income that you might need, depending on how you've dealt with your expenses. So that's just one thing to look at. Let's see. Another question is, what is the best strategy for paying debt off quickly? This is probably the most asked question I get. Um, on chats and different things is, how can I get out of debt? I want to pay my debt off. There's several videos on the channel. I have one that compares the debt snowball and the debt avalanche. We've talked about that a lot on the channel. But the debt snowball is basically paying the smallest to the largest balance. You list everything in order. The debt avalanche is highest interest first. But for example, if you were to pay off, if you were to pay an extra $200 a month on a $10,000 loan with an 8% interest, you would save about $2,500. So that $200 a month is saving you. And then now you have that extra money to put toward another loan. And that's how you just keep snowballing or avalanching it into becoming debt free. Check out those videos on the channel. Just go to the channel and type in debt snowball, and it'll pull it up. The debt snowball versus debt avalanche video. It goes more in detail, and I kind of break it down and give some examples of those. But it's a great way to get out of debt. And I've actually did a video on which way is the best method. And with a lot of this stuff, I always say it's really up to you. The best method is the one that you do. What's the best way to invest? What's the best way to budget? What's the best way to, it's whatever you'll commit to. That's really the best way. Find what works for you. I talk to people about exercise all the time. Is it better to run or do an elliptical or to ride a bike? They're all have their pros and cons, but find the one you enjoy the most, and that's the one you'll do and stick to, and that's when they'll give you the greatest results. So it's the same with investing. It's the same with paying off debt. All of these things. Learn to get involved with that. Um, are dividend stocks a good investment for passive income? My opinion, absolutely. Dividend stocks are a great way to build passive income. For those of you who watch the channel, who are familiar with me, no, I'm not big on individual stocks, not opposed to them in the essence of that they're bad. I just think for the average person, it's much easier and much safer and much less stressful to invest in ETFs, index funds, those things, mutual funds, whatever your suits your fancy. I prefer ETFs because you have that diversification. I don't have to worry about a market shift. I don't have to worry about a company changing CEOs or making some boneheaded decision that all of a sudden I have to be keeping up with that stuff constantly. The index automatically adjusts those things for me, and it's diversified. So if one takes a dive, the others, balance that out. And so, yeah, you may miss out on not getting in on, Apple when it first comes out or right before they, you know, announced the iPhone back in the day, and you'll get that mega growth. Maybe you didn't get into uh, Nvidia just right or Tesla just right, whatever the case might be. Because you can see different things that influence these companies. I'll use Tesla for an example. It had been having a great trajectory. Then the CEO does something that is very controversial, and in different places in Europe and like Germany, they're like totally not buying it anymore. So you're seeing that dropping and it's causing chaos. Whether you agree with it or not, that's not the point of this channel. The point is you have to keep up with all that. But with ETFs, you don't have to because you're diversified with all of these different companies. One I use, one of my favorites is SCHD. You'll hear that a lot on this channel. For example, $100,000 in SCHD with a 4% yield. It's a little bit below that, but roughly you're going to get $4,000 a year of passive income. Even if you never touch that, you're getting that $4,000 a year. But the CAGR, the compound annual growth rate, has been in double digits for 13 years, whatever, somewhere in there. So that dividend amount is growing each and every year, and your value, the share value, has been going up year over year. So you're not just going to stick with that 100,000. That 100,000 is growing, so that $4,000 a year will grow. So it's a great passive income. So I always tell people, look for, if you're going to get into dividend investing, it's a great way. Even if you decide to go out on your own and do single stocks and build your own little portfolio of maybe 10, 15 individual stocks, make sure they're long-standing dividends that are able to be sustained, that they're solid companies, and that those dividends are growing. You don't want it stagnant because same reason that buying power is going to lose value over time. Where if you have a growing dividend, it's going to keep up and maybe even outpace inflation for you. So it's a great way to build passive income. I'm excited. I might get a payment one month of, $3,000 for my dividends, another month that may be a little bit less, but that's a great passive income for me. And I love that because I never have to touch the portfolio. I never have to go and sell shares. I just have that dividend going into my bank. I currently still reinvest them. So, I might get a $3,000 dividend payment and I'm buying $3,000 more of that same share, and the dividends growing, and I'm buying more shares with the dividend being reinvested, and it's just snowballing. It's to me, a great way to build passive income. So something to look at, do your homework, research it, understand dividend investing, and understand your goals, understand your investing style, and understand where you're at. If you're 20 years old, maybe you don't want to be too heavy in dividends at this point. Maybe you want a little bit more growth oriented. Whereas, somebody older, in their 50s, like myself, maybe you want something that is more income producing. So at any moment I want, I can just click that on and say, now I have this income coming in. If I decide that, today's the day, I'm ready, I'm done, it's it. So it's a great, opportunity to have that there. Meanwhile, that dividend is just reinvesting and growing it, the value of my portfolio. So dividend stocks are a great passive income source. So another question here: how do you budget effectively without feeling restricted? I think the simplest, basic, just premise is the 50-30-20 rule. 50% goes toward your needs. So we're just going to use easy numbers. You make $1,000 a month, 50%. So $500 is what goes towards your needs. That's what you can spend on your housing, food, transportation, things that are necessary. Then 30%. So in this scenario, $300 would go towards your wants. That's vacations, toys, going out to eat, those types of things, entertainment. That's 30%. And then 20% goes into savings. Now, it's just a easy, quick solution, but you have to take in consideration your current, predicament. Do you have debt? Because those wants should be reduced drastically. Savings may even be reduced, so you can put more toward that debt to get that debt paid off. But that's a great way to, just kind of generalize and start going the 50-30-20 rule. But the biggest thing is to track your spending. Use something like YNAB. You need a budget. It's an app that you can use. Mint used to be really popular. You can look at Pocket Guard. I have a review on the channel. You can check out a video on Pocket Guard and how that it can benefit you. You can go down in the link in the description below. There's actually a link to the Simply Money Mall, and there's an app that you can download on that as well that can help you budget. It has all sorts of other tools for your financial literacy and helping you with finances. So lots of opportunities out there. I use personally, I use a ledger, an old book, old fashioned, but I do track it on an app as well. And I use the Simply Money app that we have. Um, that's my preference. I'd love for you to use it, but again, use what works for you. Some people like every dollar, other people, it just whatever works for you. Find what, maybe you're really into numbers and you like stuff that has lots of charts and data, and some people just want it super simple. Find what works for you. Do a little research, play around with some of their free samples that they have, their trials. Find what works for you and then stick with it, because that's the most important part. um see, here's another question. What are the best ETFs for long-term investing? That's a loaded question. um Long term, I'm going to say is 10 years and beyond. I'm thinking really more 20, 30 years, but 10 years can be considered long term. So what's the best ETFs? Again, I go with um, where you're at, what are your goals? But some of the things you want to look at is, I'm just throwing this out there to the general audience, the average everyday, maybe newbie or just getting started, or somebody that doesn't want a lot of headaches and isn't going to want to track it and really worry about it. Look at two different things. One is you got the broad market ETF, like VTI, which is a total US market. Um, Basically every stock out there, and it's allocated and it just follows whatever those are, and that gives you great exposure. It's a little bit less volatile, much more diversified than just the S&P 500. But I also, again, if you have more a little bit more tolerance, go with S&P 500 like FXAIX. Get 500 companies. You're diversified. You're getting the more high growth, a little bit more technology in that. There's lots of great ETFs out there. SPY, VOO, all of the, I mean, there's tons of them out there. But get something that is diversified, that is low expense ratio, and just put your money in that. If you're, especially if you're new, if you haven't spent time researching and understanding, you're not ready to get into dividends, you don't want to get too diversified. Just start with something simple like that. As you grow more comfortable, I can tell you, worst case scenario, if you spend 30 years and all you're doing is investing in VTI or FXAIX, in 30 years you're going to be in great shape. Those are going to average 10-11% over those 30 years, and your money is going to compound really nicely. And especially if you're not watching it, you won't have to worry about the ups and downs. You're not going to freak out in 2022 when it drops. You're not going to freak out in COVID when it bottoms out. So you don't have to worry about it because they've recovered. They've recovered and gone way above where they were. So it's a great place to put your money and let it sit and just keep throwing money in there on that dollar cost averaging. Again, one of my favorites is FXAIX because it's so cheap. 0.01 expense ratio is basically free. It's such a minimal expense on that. Um, let's see. Last question I have here. How do you build wealth without taking huge risk? That's a good question because a lot of people are afraid of the stock market. Check out a video I just did like last week on myths about the stock market, and I show the percentage of chance that you would lose money in the stock market in 6 months, a year, 5 years, 10 years, 20 years, and then what the average return or the possibility of return is. And seeing the comparison that is really eye opening, especially when you get to the 10 years and beyond, where your odds of losing money become zero. And I'm not talking losing all your money, I'm talking about losing any money. The odds of losing money over 10 years is basically zero. Your money is going to grow, and the odds are very good that it's going to grow 10% if you're in something like the S&P 500. So the best way, in my opinion, to build wealth without taking huge risk, obviously starting your own business is one of the best ways to build wealth, being an entrepreneur. But there's huge risks, lots of work, and for a lot of people that's not an opportunity, or maybe it's not in their their DNA. They're just not that personality. Just talking about buying assets, constantly be buying things that are assets and not liabilities. Cars are liabilities, real estate's an asset. you know Vacations, they're good experiences, but overdoing it can become a liability. And I don't want to get too into this. I think vacations are good and you need experiences, but some people live way beyond their means on their experiences. So there's lots of ways to have amazing experiences without breaking the bank. But building wealth without taking huge risk is invest consistently, dollar cost average. Put money into your investments, into assets on a regular basis, every week, every month, every paycheck. Put money in, dollar cost average, and diversify. We talk on this channel mostly about the stock market, index funds, ETFs, diversifying that way. But perhaps you want to get into real estate. Perhaps you want to start buying rentals. Just make sure you're not leveraging yourself and getting yourself in a bad predicament. If you want to be exposed to real estate, look at getting into a REIT. It's basically an ETF made of real estate where you're part owner of these real estate establishments. Some of them are retail, some of them are commercial. Just do your homework on those, and you can be exposed to real estate that way. And avoid speculative bets. Avoid buying into the newest shiny object, the thing the news is dangling, in front of you. That's a big thing right now with cryptocurrency. And I know people have made money on it. Don't get me wrong. People have made money in lots of speculative things. But what we don't hear about, because they don't put it on the news, is all the people who lost everything on speculative bets. So my opinion is building wealth without taking risk is invest consistently and diversify, and just stick to that long-term game plan. And they say the average millionaire has 7 income streams. Consider stocks, real estate, maybe a side business. You have like dividends, that's a passive income, that's an income stream. Maybe you have a rental, and maybe you have several rentals. So if I have 3 rentals, that could be considered 3 income streams. Um, if I have a side business that produces a little bit of money, that's an income stream. Maybe I have a pension, that's an income stream. If I, obviously, when Social Security kicks in, that becomes an income stream. So there's lots of income streams you can look at. Just you don't have to have 7. Just look to diversify and have opportunities for different income streams. So those are all the questions we have right now. If you have more, throw them down in the chat. Even after this, those that watch it not live, feel free to throw those in the chat, and I can answer those in the chat the best to my ability. And I appreciate you joining me on Simply Money. Be consistent. Stay with it. Don't give up. Have the long goal in mind. And I appreciate you joining me. I appreciate those that support the channel. If you like the videos, hit that and subscribe button. Don't forget to hit that bell so you get notified when different videos are dropping. And I appreciate you being part of the community. And thank you. And we will see you next time on Simply Money.